All investing is subject to market risk, including the loss of principal. Past performance is not a guarantee of future results, and there is no guarantee any investment strategy will achieve its objectives. This information is provided for illustrative purposes only and is not a prediction, projection, or guarantee of future performance. This podcast is provided for general and educational purposes only and is not intended to constitute legal, tax, securities, or investment advice or recommended course of action in any given situation. All opinions and views constitute our judgments as of the date of production and are subject to change at any time without notice. Welcome back to the Dakota Studios. Today we have the next manager interview with ArrowMark. Rob Brown leads ArrowMark's commercial real estate finance business and is the portfolio manager for ArrowMark's CRE Structured Credit Fund. Additionally, he is a member of ArrowMark's CRE Investment Committee. Mr. Brown oversees the CRE platform, including capital relationships, as well as sourcing, pricing, structuring, and asset management of new investments. Prior to joining ArrowMark, Mr. Brown was a managing director for JCR Capital, where he built the firm's bridge loan program and other structured finance strategies. In addition to managing the day-to-day operations of the CML debt platform, he was a member of JCR's senior management team. Prior to joining JCR, Mr. Brown was a member of Deutsche Bank's commercial real estate group from 2006 to 2014, where he worked on their U.S. and European commercial real estate financing platforms. He began his career in real estate capital markets group at Prudential Financial. Mr. Brown earned a bachelor's degree in American history from Washington and Lee University. We're very excited to welcome Rob Brown in the studio in from Denver. Thanks for coming to Philadelphia to join us.
Thanks for having me. It's great to be here.
We're very excited to bring this interview. Today we're going to be talking about ArrowMark, which has built a multi-billion-dollar real estate platform. We're going to talk specifically today about commercial real estate finance, the opportunities there. There's a lot going on in the market that are creating these exciting opportunities, and what you guys are focused on in the next 5 to 10 years at ArrowMark. But just to level set, in terms of your background, would you mind providing just a little bit of detail about what brought you to ArrowMark and also to build out ArrowMark's commercial real estate finance platform?
Yeah, sure. So my quick background, I have always grown up working in commercial real estate and commercial real estate finance. Started off my career out of undergrad in New York working for Prudential in their real estate capital markets business, really focused on securitization when CMBS was kind of at its peak, and always had the itch to really get closer to the real estate and closer to the assets. So over the course of my career, moved into more of an origination role where we're working on individual transactions. And then kind of before, during, and after the GFC, actually worked on some asset management as the markets were changing. After kind of leaving Wall Street, I moved out to Colorado, joined a real estate private equity and finance business that was really targeting middle market commercial real estate assets after the GFC, and that's ultimately what led me to ArrowMark. I got an opportunity to come in and help build a franchise within a broader asset manager, which has been really exciting.
And you've seen remarkable growth at the firm. ArrowMark has grown really quickly in real estate credit specifically since 2019, I believe.
Sure.
And what do you see as the firm's biggest differentiators compared to your peers?
Yeah, I think that it's like anything. When you go and you have the opportunity to start off a business, I think the mindset is always to take kind of the greatest hits of your previous experiences and kind of extract the stuff that were either distractions or themes or products that you didn't really agree with. So we always say at ArrowMark that there's quote unquote a better way, and we've been trying to build a real estate franchise with that mindset. A little bit of that is the clients that we work with. A little bit of that is the positioning of the program, and a little bit of that is just the culture within the team itself.
And we're going to get into the market opportunity in a second, but just from a strategy perspective, can you give us an overview of the strategy behind ArrowMark's CRE structured finance strategy?
Yeah, sure. So first of all, the business itself has continued to grow. So the first initial products and clients have really expanded and grown over time. Two is the market has changed a lot. I think when we set off to build the franchise in 2019, I always say that the business plan has actually stayed fairly intact. What we didn't have in there was this incredible interest rate rise, COVID, geopolitical distractions. And so actually what I think we take solace with the franchise is the fact that we've been able to build in a fairly volatile time. And a lot of this actually worked to our advantage, right? We didn't have legacy issues. We were able to be nimble. We were able to see pockets of opportunity where other larger organizations, maybe, it just wasn't efficient for them to change tact.
And what type of investments are you targeting today?
Yeah, sure. So we a couple of things. We invest in commercial real estate. We do that nationwide. We focus on all asset classes. So we're a generalist in that sense. And I'd say also to our product, while most people view us as a debt provider, I think it's really more of a credit business. So we provide first mortgage financing, both fixed and floating rate. And we're also able to provide other products throughout the capital structure, whether that's mezzanine debt, preferred equity, or in some cases what I call structured equity.
And that's what we're going to get into a little bit further, but the structured equity piece, lenders or owners looking for capital solutions in this market environment, and what you guys are providing that solution to them.
Absolutely. So one of the dynamics that's going on in the current market too is a lot of these borrowers and sponsors, they know what they want, but they don't know what they can get. And so the platform, and really through our fund, is now able to provide these capital solutions to these middle market sponsors to solve their immediate needs, right? They've got maturing debt. They've got legacy equity investors. They've got business plans that need to get redone. And so we tend to take a pretty open view as to the capital needs of those counterparties and how we can kind of best match the opportunity to the capital.
And you talked a little bit about how the market's changed over the past really 5 to 7 years. Particularly today, why do you believe middle market commercial real estate credit offers one of the most compelling risk-adjusted returns?
Yeah, it's been a fascinating time, and I say that I think that a lot of us in the industry anticipated that rates were going to go up, but what we didn't anticipate was how fast, right? And so the game changed really, really quickly. And now we're in this mindset of higher for longer with interest rates, right? I think that the optimism in the commercial real estate industry was that, the rates were going to go up and then they were going to come back down, and it was going to be kind of business as usual. Everyone has to change their playbook, right? In terms of the opportunity within real estate credit, there's a few things. One is there's real yield in credit now, right? And you hadn't seen that when rates were zero, right? Managers were having to use an incredible amount of financial leverage to generate the returns in a credit strategy that investors wanted. It's not saying it's easy now, but it is easier. The other piece of it too is exactly what you touched on, where a lot of these assets are going to have to be recapitalized over the next 2 or 3 or 4 years. And you're going to have to be able to come in with a creative capital solution. And a lot of that is going to be driven through more credit strategies than opportunistic equity strategies, in our opinion.
And you started to talk about the different components of the debt structure that you invest in, the B piece, mezzanine, preferred equity. Mm-hmm. How do these structures protect downside risk while capturing upside as well?
Yeah, sure. So a lot of that is just discipline from growing up in the business and the discipline that we outlay within the platform. But one thing, the one thing that we like and appreciate in the middle market versus the institutional space is really structure. So you can get structure in the investments we have, whereas the institutional space tends to be more covenant light. So whether it's a piece of debt that we're writing or a piece of preferred equity, well, you'll see in a lot of our investments are performance thresholds, maturity dates. You have to kind of interact with us on a very regular basis, right? That doesn't necessarily save the day per se on said investment, but it does keep us much more informed and be much more proactive from an asset management perspective, which ultimately should be able to drive recovery if these business plans don't track to the way they do. The other piece of it too, within kind of our credit tilt and our fund business, is the contractual components of our returns. So I would say that between 80 and 90% of our returns in our fund, whether it's debt or whether it's preferred equity, is a contractual component. So we're not so much relying on profit shares and equity kickers. We do have those and we do implement them from time to time, but a lot of it is very predictable returns, which we think our LPs really appreciate.
And we just got through, or kind of on the other side, hopefully, of this interest rate rising environment. When you look at it too now that real estate values have more settled or moderated to some extent too, what about the attachment point that you're the assets you're basically investing behind?
Sure. Generally speaking, I think with kind of the run up in 21 and 22, we think that real estate values are probably down 20 to 30%. that is a very broad number. And I think also you've got a lot of maturing debt that's coming due over the next 2 or 3 years. This is going to create a ton of opportunity for real estate capital providers like ArrowMark to be able to invest capital in a very interesting way. And we're able to take leverage points or attachment points that you see that are on a very conservative level. So we feel that there's going to be a massive amount of asymmetry, particularly in the credit space, where you can take a position in the capital structure, generate very interesting risk-adjusted returns.
We talked about the loans that are all maturing in the next few years to the tune of over $2 trillion. Where do you see the most dislocation and opportunity with that in mind?
Yeah, sure. So let's talk a little bit about the middle market, which again, we consider the middle market as assets that are $100 million or less in size. So from a transactional perspective, 2/3 of the capital that transacts is in this middle market space. But that 2/3 actually accounts for 97% of the deals, right? So you have this denominator effect that really creates a great opportunity for just deal flow. Right, and I think I think that's also compounded by what you're seeing with a lot of the local and regional banks. Historically, these local regional banks account for approximately 50% of the debt in these middle market transactions. And as you and I know, that those local and regional banks have really pulled back, and that provides opportunity for groups like ArrowMark and other non-bank lenders to step in and take market share.
We discussed it a little bit earlier on the rate environment. Rates are very high. Valuations are slightly different over the last few years. How do you underwrite these deals compared to where rates and valuations were just a few years ago?
Yeah, sure. So again, just to reiterate, we as an industry and ArrowMark as a business, I don't think we were surprised by the rate movement. It was really the pace, right? It happened really quickly. And there was an unbelievable amount of capital that was deployed late cycle. And all of those investments are now kind of coming through their 2 or 3 or 4 year business plan. And so those capital structures will implicitly need to be adjusted. They will need to be recapitalized. Assets will need to be sold. It is a perfect environment for a platform like ArrowMark where we can sit there and take a view on whether or not we want to provide debt capital, equity capital, or some gap equity in these assets. The other aspect to it is how do you underwrite this new world we live in, right? So the cost of capital, particularly on the borrowing side, went from 3 or 4%. It's effectively doubled, right? If you go out and get a Fannie Mae loan or bank loan or insurance company loan, let alone a loan from a debt fund, you're paying 6 or 7%, right? That was not in the original business plan, and so the sponsors are going to have to go out and recapitalize those assets with fresh capital. This is going to be in a great environment for groups like ArrowMark to be able to deploy money into those type of transactions.
So turning to some of your track record and platform strengths, Fund 1 still deploying capital. Could you maybe highlight a representative deal or case study that highlights your approach?
Yeah, sure. Generally speaking, the themes within the investments in our current fund are what I would call bridge to better times. And so for the most part, a lot of the assets are borrowers or sponsors who've actually owned the property for the past 2, 3, or 4 years. And they may have executed on their business plan, right? Like occupancy is high, rents are going up, they're trying to manage their expense load because, as we all know, insurance is up, real estate taxes have tended to increase, replacing a roof is a little bit more expensive than it used to be, right? But at the same time, that sponsor, although they may have executed on their business plan, they don't want to sell into this current market environment, right? And so what do they want to do? They want a 2 or 3 year window where they can continue to execute their business plan and ultimately sell when market conditions are a little bit better. Maybe that means that interest rates have dropped, right? Maybe it means that there hasn't been much construction over the past 2 or 3 years, and so maybe you'll be able to see more like cap rate compression, right? And so we've been able to step in and provide that kind of 2 to 3 to 4 year financing, whether it's senior debt or it's kind of gap equity or preferred equity, and to a bridge to better times.
Would love to hear about this sourcing network that you've built at ArrowMark. You have these insurance company partnerships and other strategic sponsor relationships. How have these created unique deal flow for the firm?
Sure. So one of the fundamental differences within the ArrowMark commercial real estate platform is how we capitalize our transactions. And over time, we had gotten to know several insurance companies. We'd really studied their balance sheet, their needs, and really the issues that they had in terms of deploying money, and created these very bespoke relationships where we would go out and originate commercial mortgage loan products structured as our separate managed accounts or formal lending joint ventures, right? And that's kind of the antithesis of my background growing up on Wall Street, where a lot of the investment managers will raise discretionary funds and use either warehouse or repo financing to finance their businesses. And we just feel like working with the insurance capital is a better way. It's more sustainable. It's a better borrower experience, and ultimately it's a little bit of a path less traveled, but it's proven, especially in these volatile times, to be the winner in the long run. And over time, what we've done is we've taken kind of those initial commercial mortgage lending businesses and kind of built out products alongside them, and they all effectively complement themselves. And really what that does is creates an unbelievable network effect with the users of this capital, the mortgage bankers, the correspondents, and the borrowers who can come in to ArrowMark and they can look for a 5-year fixed rate loan, or a 3-year bridge loan, or a piece of preferred equity, or maybe they need actual real equity in a short time frame. We can operate in those 3 or 4 lanes of traffic and be able to provide the borrower, the user network of that capital solutions in this middle market space.
Is there a specific case study that you can provide that highlights those relationships you have with the insurance companies?
Yeah, so we recently funded a student housing project in UT Austin, University of Texas, Austin, and it was an acquisition loan. So it was an out-of-town owner who was selling the asset. It was a legacy asset. They'd kind of taken their eye off the transaction itself. In comes a local owner-operator that we had known. They needed an acquisition loan. And really what they were looking for was kind of normal leverage. They typically, you will borrow kind of 65% on acquisition. They went out to the market, and because the cash flows had dropped because of previous ownership, a lot of the traditional lenders were kind of capping out at that 50 or 55% loan to value, right? And that was basically, they were constrained by debt service coverage ratios versus loan to value. And so because of the partnerships that we have with the insurance capital, we were able to provide that sponsor with that 65% acquisition loan. And really what we did behind the scenes was just created an A tranche, which then gets funded by the insurance company, and then our fund takes that B tranche. And so the insurance company, the win-win in the scenario is that the borrower gets their 65% loan to value loan. Our insurance company gets that senior portion of the mortgage structured as an A note, and then the residual, right, gets capitalized through our fund investment. And we wrote them a 3-year fixed rate loan, provided them with some additional funding to go in and renovate the units because some of the amenities were outdated. And ultimately, this is an asset that would probably get financed by Fannie or Freddie or some other insurance company once the sponsor has completed their business plan.
Could you provide us a little bit more color on the firm's portfolio construction and diversification when it comes to asset classes, as well as maybe different types of notes that you write? Yeah,
sure. So I touched on it before, but from an asset class perspective, we are generalists. So we do have our favorite asset classes, the main food groups of industrial, multifamily, retail, and office. We also invest in what we call specialty asset classes. So think of that as student housing, hospitality, medical office, data centers, right? So we have the ability to be very diverse in terms of asset classes, also in terms of product type or instruments within the fund. What we're trying to do is create a nice portfolio effect where the fund itself is a mix of first mortgage or proprietary B notes. Let's call that 30 to 40% of the fund. We have kind of the other structured credit investments. I mentioned the preferred equity that makes up another kind of 30 or 40%, leaving us with a 10 to 15% slug of what we've marketed as special situations. We have quickly rebranded this 911 phone calls in today's market environment. And those instruments that were super disciplined, those are really more episodic and more time is of the essence type investments, and just provides the LPs with a little bit more alpha in the portfolio.
On the risk side, there's a lot of, obviously, sort of we talked about the interest rate environment, some of the macro challenges that are facing the industry more broadly, and how you guys are providing, structured solutions to mitigate some of these. And you also mentioned just kind of the inherent structures themselves as being, opportunity to, realize returns in a more protected manner too. But there's obviously always, just in any business, there's always certain risks that you can't avoid. So what were the key risks that investors should consider when thinking about CRE credit, and how do you guys mitigate those risks?
Sure. Again, back to the middle market positioning, we've been doing this now for a long time. And I think that the middle market is a space where institutional asset managers, they have left that space and they're not coming back. And it's primarily because it's really inefficient for them to deploy capital at scale, right? And so we feel like that is a great opportunity for ArrowMark. The caveat to it is you have to understand how to navigate it, right? You have to filter good deals from bad deals, which is kind of obvious. You really have to underwrite your borrower. You have to understand like real human alignment, right? In the middle market, assets trade not because of macroeconomic trends, but there's a lot of idiosyncratic reasons why assets trade, right? It's estate planning, it's health, it's divorce, right? It's the family office needs liquidity, and so all of a sudden that asset comes onto the market. So we spend every day studying that pattern recognition. Our investment committee will always ask certain questions as to how this deal got to us and why we are the best suited. But ultimately, at the end of the day, it's underwriting real estate, right? So we want to understand what is our basis per square foot, basis per unit. Break that down and let's understand that. Ideally, you're investing below replacement costs, right? That's a great protector. You want to understand who your borrower is, right? How long have they been doing this? Are they a tourist, or are they an expert in this space? What is their financial alignment, right? Where is their capital coming from? How many fees are driven by this deal? Right. Ultimately, are they in a promoted structure, or is it a different situation? And so we peel a lot of that back. And the last piece of it too is really the business plan for the commercial real estate asset. Right? Do they have to pull off the triple Lindy to pay us off, or is this kind of a gradual harvest of the rent roll? Right. A good example is multifamily. Right. We always ask, like, understanding that if and when they finish this business plan, will this be an agency eligible loan? That if it is agency eligible, there's a ton of liquidity that will be used to be able to pay us back. And so these are the debates that we have in our daily, weekly pipeline meetings, our investment committees meetings, and also really with our investors.
So in summary, it's been domain expertise for the firm, seeing basically a lot of deals and developing that pattern recognition over time, and then really understanding intimately what the incentives are for the parties involved within each investment to mitigate from some of those risks.
Yeah, absolutely. And I would take it one next level too, is really the asset management and servicing aspect of those investments once we make them, right? It's always nice to be able to ring the closing bell when a transaction closes. It's really more important to ring that bell when that investment gets realized, and that, right? So there's really kind of 2 or 3 touch points of that investment, but all of the risk in the transaction takes place from closing to realization, right? It's really not in the investment committee analysis itself. It's in that 2, 3, 4 year where that capital is being deployed and is at risk.
Looking ahead for allocators listening today, what should they take away about why this is a good vintage for CRE credit?
Yeah, I mean, this could be one of the best credit vintages of my career for everything we just spoke about. Like, there's real yield in the world finally. Assets will have to change hands over the next 2 or 3 years.
They're actually transacting and moving.
Absolutely. And then when you have kind of the old OG stakeholders like the regional banks who are probably pulling back, that's going to create pockets of opportunity for folks like ArrowMark and other investment managers in the credit space. So we're super excited, and we think we're very well positioned. We think our investors will have a really good experience, and more to come.
And what about over the next 3 to 5 years, just for the business too? What most excites you about?
Yeah, I think first and foremost, it's really executing on the mandates that we have within the platform right now, right? And whether that's the commercial mortgage lending operations that we have with our insurance partners, it's some of the lending JVs that we've built out, it's the fund investments that we are currently deploying. So that's kind of first, second, and third. And I think over time, it's having the intellectual curiosity to continue to grow and build and find pockets of opportunity and find good people and find additional clients and just continue to build an enduring platform.
Well, Rob, thank you. That's super insightful, and really appreciate you taking the time to come in to speak with us today and sharing these insights and wish you nothing but the success over the next 3 to 5 years.
Great. Thank you. I really appreciate it.
Absolutely. And thank you all for joining us today. Take care.